Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go, generally related to three different topics: wealth building, commodities, and/or financial topics. Dive in, let's take a look and see what's going on today. You can find me at finding_finance, and you can join our community at finding-value.com, where I dive deeper into all of these topics, generally related to commodities, looking for uh, investments that are undervalued. Coming down to Calvin, he says people today are remarkably impatient and short-term oriented. Take a few hours every day just to read. Investing is a long-term game. Think long-term. Train your mind to tune out the news flows and think in years and decades. I would agree with that. If you're trying to make money in the markets, you're trying to buy when sentiment is bad and sell when sentiment is good. And the rotation between poor sentiment and good sentiment usually takes years, sometimes decades, depending on the bottom to top of the sentiment. So, bottom being 2020, the top of the sentiment being completely changed. Could be something like 2030 or 2035 or 2028. 8 to 15 years is generally the time frame it takes to go from complete negative sentiment to complete euphoric market top for commodities and some of these other investments. Daily Chart Book says macro surprises and inflation surprises are finally back in sync after 2+ years of divergence. They believe that we are on a path to Goldilocks in 2024. And the Goldilocks era is moderating but stable macro and cooling consumer price index. And that's Bank of America. So they think that we potentially are in a Goldilocks period, which is really good for stocks, S&P 500 technology stocks. That is their opinion. So that's what their opinion is. Another one from Calvin says, I just don't see the reason for Valet pessimism. I'm with the koala on this one. This is a fantastic opportunity. I agree, but this also mirrors this pullback in the Goldilocks and what people think. So what people think matches the price performance. Another thing that this matches is a stronger dollar. A stronger dollar and a weaker Brazil real will push and keep Vale down. It'll keep a lot of these commodities down too with the stronger dollar. So what Powell has done in order to create the perceived perception of Goldilocks is he's raised interest rates really quick in 2021. He's held them high and he's maintained a stronger dollar versus other currencies. And commodities and all these other things are priced in dollars. So he's basically keeping like a lid on everything through a stronger dollar. And that is where the perceived Goldilocks comes from. If the economy does weaken for whatever reason and unemployment goes up, that is when Powell's going to have to be faced with, do I keep interest rates elevated to hold the dollar strong, or do I save unemployment, which is another one of his metrics, and let inflation come on back? So that's where I think he is at. I think that's where the markets are at right now. I'm curious to see if he can hold rates higher for longer without unemployment going up. And unemployment does look like it's turned a corner and starting to turn higher. Here's Christine's take on oil and gas versus the two candidates. So her take on Trump versus Harris for oil and gas. Trump is bullish domestic oil services like rigs, refiners, GOM exploration production. Gulf of Mexico is what GOM is. Harris is bullish international exploration and production. At the end of the day, global supply and demand is more important than who is in the White House. With the Permian bottlenecked, It's an OPEC, China, India story now, in her opinion. Kevin says the misery index, which is the consumer price index year over year plus the unemployment rate, is near a level that is typically seen when the Fed has started cutting rates in the past few cycles. So we've got the Goldilocks opinion up here from Bank of America. And here we've got a different situation where when we get to these levels, we could potentially see a Fed starting to cut rates. That's not really Goldilocks, that's more of a slowdown. So again, we'll see what occurs here and if we get potential rate cuts. You can see that coming up there and then coming back down. So we've come on down quite a bit here for the quote misery index. Mike Zaccardi says the consensus sees a 30% probability of a recession within the next 12 months. So that is the consensus, 30% probability. We were that low in 2021, was a similar reading, 2022, I should say here, and in 2021 in the beginning, 2021. Daily Chart Book says the S&P 500 forward earnings is our favorite leading economic indicator. As long as we don't anticipate a recession, which we currently do not. So the coincident or coincident economic indicators versus S&P 500 forward earnings, you can see that we are positive here for forward earnings, and the economic indicators are still positive. So in their opinion, no recession at this time. Gold miners and gold exploration companies are set up for an explosive move during the sector rotation following the unwinding of the AI irrational exuberance. So he's got gold miners versus semiconductors in a falling wedge at a very low level. What he has here, this is from Grady, the 17-year perfect bullish falling wedge, saying a historical global sector rotation and change of capital flows is in the making. And he's got the Huey versus the SOX, which is the gold bugs index versus the semiconductor ETF. And he thinks there's a huge potential outperformance for the Huey. And that'll be a combination of the Huey going up and the SOX going down. Daily Chart Book, we continue to record readings on financial stress at all-time lows dating to 1990. So Bank of America, Gapin Gapin, is saying that financial stress is near all-time lows all the way back to 1990. It is the lowest reading that we have seen in terms of lower stress in the system, financial stress. Variant perception, another opinion here. Our growth leading indicator continues to show a broad-based recovery both in the major markets and emerging markets, with almost all our countries' leading economic indicators improving versus a year ago. You can see we came on down in 21, 22, bottomed in 23, and are starting to head up later 23 and 24 in those indicators. So has the slowdown already occurred and is behind us? Or is it out in front of us still further ahead of us? Richard Bernstein Advisor says the Fed keeps telling everyone supply chains have normalized, but container rates are screaming the opposite is true. What's going on here with container rates continuing to go up? That was very reminiscent of 2020, 2021, not the Goldilocks era, which is weird. Goldilocks era is what it looks like before this, kind of flat. So we've got all these opinions, but the data isn't really matching up across the board here. Car prices are crashing. Used car and truck prices are now down 17.5% since the 2021 peak, and the largest decline in 15 years. Over the last 35 years, there were only two times when prices of used vehicles saw a bigger decline. It was in 2004 and 2009. Overall, U.S. wholesale prices of used vehicles have declined 22 consecutive months. In June, average wholesale prices decreased by 9% year over year, about 18,000 bucks. EV makers have been hit the hardest, with some EV prices falling over 40% since last year. Car market bubble has popped. Well, hasn't it already popped? And when is the potential bottom? Maybe when we hit this support level at 160, perhaps. But right now, maybe it's a good time to be looking for a car and haggling down on prices if you can afford it. Shanghai gold premiums are holding at 0.3%. So that's good as metal continues to move from the west to the east as those premiums are holding steady. We've got Brandon here. He says, I love how investors are like, I only invest in stable jurisdictions with sound governments. That's why we invest in U.S. markets. My brother in Christ, we haven't seen our president almost a week since he's resigned from office. Just invest in South Africa already. I think that's funny, but I do agree with the jurisdictions. Some people say jurisdictional risk. I don't know how to risk half of these countries. U.S., not a great market in terms of jurisdictional risk for some of these base metals. They haven't really moved forward with their projects. Canada, I can't say that's all that much better either. And the lead times are absolutely atrocious in some of these markets in what are perceived to be stable jurisdictions. Uranium supply and demand imbalance likely to grow according to the Sprott and IEA. So uranium supply and demand imbalance is likely to grow. We believe the era of inventory destocking is over. Demand for uranium may likely outstrip supply with a 1 billion pound deficit 2024. Now, it says net zero nuclear, the pledge to triple global nuclear capacity by 2050, would result in a 2.2 billion pound deficit. And to look at that from a graphical representation, the demand case for the base case is this green line. The demand net zero nuclear goes straight up the angle and to the right. The gap between mine supply, which is declining here, and the potential demands are on the right here. To me, from the green line down, it looks like we need to double production at least. And this up here almost looks like a tripling of production of where we project it in 2040. So we need a lot of work to do if we're going to hit anywhere near the uranium supply to meet this demand. Investment wisdom, Howard Marks, the relationship between price and value holds the ultimate key to investment success. Buying below value is the most dependable route to profit. HFI research says, coiling, I think the oil market is coiling. Everything I'm seeing makes me believe that oil prices are skewed to the upside. And I know we've got some recent selling pressure in the near term, but we are actually still in a coiling pattern. That is still true, even though we could still see further downside in the short term. Michael says, given demographic trends in Europe, Germany, and Italy will be next. It's fine to own a house for sentimental reasons there, but investing in residential real estate is madness. And this is talking about Japan, and Japan is grappling with 9 million empty homes, more than the population of New York. Previously seen mainly in rural areas, abandoned houses, or Akiya, however you say it, are now spreading to major cities like Tokyo and Kyoto. In gold we trust, are you long enough? This is the gold miners' bull bear markets from 1970 to 2023. The bull markets and their returns over these periods. We've got a 600% increase, a 554% increase later 70s. In the mid 2000s, we had two bull markets, 1,330 a pullback of 67%, and then another 273%. And then we've got an uncategorized move here recently. So the bull markets were pretty big. We had two big ones back to back in both of these cases. And we're looking for another bull market that's coming here. The reason I say we're looking for a bull market is because gold's broken to the upside. Same with silver. And the gold and silver mining companies have broken the downtrend against gold. So that looks good for a potential bull market that is ahead of us. But those are the returns. And some of the smaller companies during this went up ridiculous amounts. We're talking like 2, 3, 400,000% returns in that time frame or greater. And that, I should say, not 1,000%, 100, 200x, 10,000% returns. Charlie Munger's 5 investment skills to develop: the ability to keep raw, irrational emotions under control, patience, discipline, an ability to take losses and adversity without going crazy, and the ability to not be driven crazy by extreme success. A lot of this is controlling emotions, being patient enough. Discipline and patience, I think, go together. And ability to take losses or gains in either direction and not be impacted by it. Eric says inflation was a lot more transitory than most people predicted. Goldman Sachs core inflation tracker is now below 2%. And that's what they're showing there for core inflation tracker and the PCE inflation. A lot of people are claiming victory on inflation at this time. Goldilocks period is ahead of us, according to them. Bar chart. Cathie Wood bought the dip in CrowdStrike on Friday, but unfortunately, the dip kept dipping. ARK Invest lost 1.6 million on the CrowdStrike position today. She is trying to catch a falling knife here. And I don't normally do that. When you get large selling pressure like we've experienced in CrowdStrike, I generally don't jump in front of that train and try to stop it. I wait for the momentum to dissipate. I wait for a basing period first. So she's jumping right in front of that train, and that's very dangerous to do sometimes because it can just keep dipping. Jesse says, there's no assurance that the market is in fact at a peak, only that current conditions are more consistent with a major peak than at any other point in history, including 1929, 2000, 2007, and 2022. Wait. I thought we were entering the Goldilocks period. What the heck is this guy talking about? So this is the Hussman Strategic Advisors, the cluster proximity score plus the cluster correlation differential, blue left, proprietary composite and short intermediate term market over extension. Market cap divided by GVA, S&P 500 index. So they're saying that we are overvalued, basically, and that we are extended to the upside. And this has been very synonymous with other market tops. A little bit of conflicting data going across some of these opinions now across the board. What gold can be in the second half of the year, and this is gold seasonality calculated over the last 50 years. It's done real well in the beginning of the years, January through February. It's had a consolidation from late February all the way to early July, mid-July, and then a move higher from July all the way till the end of the year, up all the way to about February of the year after. That's what seasonality looks like. It looks good from where we are positioned today if it were to repeat. Logan says, to show you how crazy the housing bubble years was from 02 to 05, those price gains were happening with rising inventory and home sales in the last 5 years. Active inventory falling toward all-time lows was an issue that record low sales didn't create the crash in prices. But he wanted to make that clear to everyone. It says, let's cut the Fed funds rate with record low inventories. And inventories went up with active inventory rising for a while, for 5 years. Elon gets it. Things are accelerating now. So it says where we are with the dollar value destruction in the dollar, you might ask. It says silver, then receipts for silver, then just the receipt with no silver. And then it says you are here between Zimbabwe, which is hyperinflation, and potential civil unrest. Jeff Weiner, I think that Winiger, however you pronounce his name. In the 7 prior cycles, the Kansas City Fed's labor condition moved in tandem with stocks. Labor conditions up, stocks up. Labor conditions down, stocks down. But for 2.5 years, this indicator has been falling while stocks keep running. Is it a busted indicator or is the S&P 500 in a danger zone? And what he's talking about here is you can see this indicator went up and down the same time that the S&P 500 has, except since 2020 and forward. Like something isn't working here. I have noticed this. The market just keeps going up, and I know I've been a bear on the market for the S&P and the NASDAQ. It's because all the indicators are saying it should fall for the most part since 2021, 2022. But it keeps going up since 2022, and it's like, what's going on here? And I think this has got a lot of people kind of mixed up. That's where I'm going to end it there, guys. So that's what I've got for today. Thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. And that's where I'm going to leave it, guys. So we'll catch you next time. This is Finding Value.